So if you're into crypto and pizza, you've come to the right place. We're going to go over some numbers from Coinbase and also talk a little about Domino's Pizza internationally. So let's jump right in. So I want to start with Coinbase first. And if you take a look at the chart here, it's down, 81%, quite a bit actually. And the headlines today from the earnings, not so great. You can see Coinbase posts 557 million loss with eyes on expenses. And guys, this is just for a quarter, losing 557 million is really a lot. And the full year is also pretty ugly. I want to show you a little some more numbers as well. Take a look at this. This is saying here, it's also been losing market share, which dropped from 5.9% in November to 4.1% in February. So they're even losing market share. And that's according to Crypto Compare. And then you want to compare that to Binance, which is essentially 60% market share. They're also saying too, this is an analyst, assets on the platform fell to 80 billion, down 71% from a year ago. At the end of the day, it's a brokerage firm. And if you don't have the assets, you don't have the business. That's David Trainer over at New Constructs. And essentially what they're saying is, there's just less interest in this thing, right? They don't have nearly the amount of assets that they used to have. And also too, the value of said assets have gone down quite a bit, which essentially the crypto winner is here. Also too, another headline, Coinbase beats on revenue and earnings, but usage continues to decline. So not only are you having, essentially values go down of the crypto, you're also having less interest and less transactions overall. There's another numbers I want to show you guys as well. These are your trading volumes and also too sort of like what people are trading. So first is across the board, both consumer and institutional trading is down. You can see it's been declining since last year. This is your consumer. So this is in the billions, as it was at like 177 billion. And then that was last year. Now it's just consumers are down to like 20 billion a quarter. That's a big drop. Institutional, 371 billion. That was a year ago. And then you have quarter four of 2022 was 125 billion. So it's just down all across the board. You see numbers for yourself, but consumer, essentially your retails have really, really fallen off. The thing that I wanted to show you, what I thought was really interesting is essentially there's three categories of crypto. And for those of you interested in this stuff, you might find these numbers really interesting. You have Bitcoin, Ethereum, and other crypto assets. Now, here's the thing that's fascinating. If you look at the trading volume back in quarter four 21, 68% of the trading volume was in essentially basically altcoins. Today, it's 45%. So that tells you that really a lot of the air has been sucked out of the market and essentially down to, roughly, I say roughly, half of the volumes that are done on Coinbase is either Ethereum or Bitcoin. The altcoins just don't have the excitement they had before. So for those of you in Shiba and all that kind of nonsense, Dogecoin, I'll just be fairly honest, it doesn't look good. If I ask the robots, what do they think Coinbase is worth, and we get a fair value of $11.92, which is essentially 420% overvalued. Now, to be fair though, this is a speculative asset, meaning that, essentially a gamble where you think Coinbase will come back. It's up to you. I'm just showing you guys the numbers right now. Just looking at the numbers, they're losing a bunch of money, and the interest is dying in crypto. So it looks bad, but I get it. If you're into this stuff, you say, Chris, it's a U.S. regulated thing, and I believe in crypto. I just say, don't put all your eggs in one basket, and do what makes sense for you. So I'm just showing you guys numbers. I also want to show you guys this. Now, this is Domino's in Australia. But I think it's a really good case study because, especially for those of you who are interested in business and learning about how companies run themselves or run themselves in the ground, I should say, it's good to learn from examples. So you can read the headlines here. Domino's plunges most on record as customers shun price hikes, and the stock actually went down 24%, which is pretty crazy. They wrote a letter kind of explaining what's going on, and I wanted to go over that with you guys. You can see the plunge down there. And again, this is the Australian shares, but all business is business, and it's good to learn sort of like kind of what they went wrong, et cetera. They even say in their letter here, they say, okay, at Domino's, we talk about value equation. So that's part of the Domino's culture, their value equation, and are completely obsessed with getting this right, which in turn will deliver for our customers, our franchise, and our shareholders, Mr. Meiji said. And essentially, they're trying to explain why people, aren't buying so many pizzas, basically. We haven't always had the balance right for some customer groups, right? Trying to get the right balance, largely in delivery. As we responded to inflation, this is why I bring this up. This is essentially how businesses respond to inflation. Our franchises businesses were working hard to correct for all stakeholders. So essentially what we're talking about here is you got to run your business, but you also want to maintain profits for people who are your investors. In the initial stages of inflation, our expectation was that we could offset the increased input costs. So that's essentially like the cost of the food, the cost of fuel to ship food around, et cetera. Just the input costs are going to be going up due to inflation, right? By providing customers, and this was their strategy, more for more, right? So basically, we're going to give you more pizza, but we're going to charge you more. More for more was their strategy. That's an interesting one. Rather than passing price through, approach deep in our DNA. So essentially, the idea is like, okay, if you're running a business and essentially, right, your input costs are going up, what are you going to do? Well, one, you could just eat it and shrink your margins, or you can essentially, like what they're trying to do is the more for more strategy. Now, it didn't work. That's why we're having this letter here, but I want to keep reading it and see how they talk about it. Given the challenging conditions of our and the effect on our franchise, we felt that it was necessary to lift prices, right? Talking about raising money, raising prices, including implying some surcharges, which I'm sure you guys know customers don't like that. This was successful in protecting franchisee profitability. However, given the speed of the change, right, they did this maybe a little bit fast. It was difficult to forecast the effect on consumer repurchasing rates, especially where customers ordered less frequently, such as Japan or Germany. So what we're talking about here, which I thought was kind of interesting how they say is like, basically, you announce a bunch of, hey, we're adding like extra money on delivery fee, or we're adding extra money processing fee or whatever like that. And if you raise prices really quickly, people may say, fine, I will pay for it this time, right? Because, you know how it is like when you order pizza, you kind of made a plan in your mind, I really want that Domino's. And then after you order it, you eat it and you're like, that was really poor value, and you don't order again. That's essentially your repurchasing rates. And they were talking about something like a Japan or Germany, which may not necessarily be addicted to pizza like, say, the Americans. That's why I'm saying this is really interesting to read sort of what we're on with Domino's International. Let's read more. It meant while we saw an initial benefit to franchisees, so they're saying here initial benefits, so like that those initial price raises, that may be helped in the short term. Unit economics, specific customer groupings, particularly in delivery, reduced their ordering frequency while resulted in December trading being significantly below our expectations. So things started to go sour for them. Our data shows very clearly that our store operations are at a high standard, with customer satisfaction and delivery times remaining strong, right? So they're still operating efficiently, right? But I think they're just not getting the orders. That's what's going on here. Equally, our digital offering, including our new app, is going very well. Where we need to do more work is pricing and getting the value equation right. And I just think this part is like really, really fascinating. Basically kind of what's going on, guys, is just that as the numbers said in the headlines, they raised prices and customers weren't so thrilled about it. And I just want you to read their language from Domino's. And this kind of shows you guys, and again, I'm talking about, running a business here, is that yes, you can raise prices, crazy amounts, and yes, you may make the short-term profit, but overall and over time, and I'm just sharing you guys the business, you're in a relationship with your customer. And I'm just, sharing my experience. Like, say I go to a restaurant and like I've been going there for a year, and they change the management, and like you notice changes and you're like, wow, this is not the place that it used to be. I'm going somewhere else. And I want you to think about in your life, be it as a customer or from the other side, as a retailer or seller, anything sort of like this, is that business is a two-way relationship, and you have to think about how can you develop a long-term relationship with the customer / person you're doing business with. And so this is why I think this is a really, really good example to, reiterate how important it is to have good relationships. So basically they pissed off their customers by raising prices too quickly. And, and this is sort of the balance also too, on the other side, let's say you're running a business to, always have to be impressing shareholders. Because the other thing that happened as well with many businesses is that they might have had a really great, year, say, for example, Domino's, with everyone at home delivering pizzas, and your, profits are skyrocketing, and now things starting to slow down because, there's other options, stuff like that. And, for example, say they said Japan or Germany, but just imagine, for a time, let's say, pizza was the only thing that was deliverable, right? And then now that there's more options, it's like, not only are you charging me more money, I have other places to go. So I just want to share both these things with you guys. My personal opinion on crypto has always been sour. I've shared that many times, but I do want to just show you the numbers and see what you guys think, if it can be turned around or not. So we're talking about pizza and crypto. Please share your thoughts. Thanks again for watching, and I'll catch you guys in the next video.